November to really even just now, we just hit kind of back to the top of the range. So we've been trading this range essentially the whole time. But for a big part of 2015, like right here, the range was really tight. See that, like how tight it was up until the summertime. So like it was like maximum, you know, you may get 5 or 6% gains sometimes on a stock, and it's like that's all you can take.
And, you know, the other thing was during that range where it looks fantastic there on SPY, it was really a narrow. I mean, it kept narrowing as this thing played out more to the end of 2015. The amount of stocks that were actually up there with SPY just kept narrowing, and it made it really difficult to trade there.
Yeah, you were like basically looking at like Amazon, Google, and Netflix.
That's it. You took those 4 stocks out of the market, and the market was actually down like 8 or 10%. So yeah, it was basically that or nothing. And the total change from what we're doing now on the chart you just had up there.
So guys, let's get this thing started. So, you know, we wanted to do this webinar. So we had a couple cool things that you know, we want to talk about, and also, you know, what we've experienced in this 2016 was a little bit out of the blue, but not really out of the blue. Usually the trending sectors are always the ones that are coming off a big downtrend and some type of, you know, bottoming pattern. And we've seen it in 2016, and so it's given us a vehicle to trade both to the long side and short side. And I don't know about you, Paul. I lump in commodities with energy for the most part. You know, in terms of
definitely, they've all been
in terms of nugget and gold, and probably besides energy stocks, there's a gold, which I trade via nugget, and then U.S. steel, which I've been you know, trading on and off. Amazing range and liquidity, and FCX also. I've probably done 100-day trades in those this year.
Yeah,
so I kind of lump those. Yeah, I lump those with the energy sector too. So for the purpose of this webinar, I may jump in a little bit into the commodity side because they kind of move together, and they both are having that same longer-term bottoming pattern, which was essentially a big a multi-year type of downtrend or quick downtrend where there was, and where now you're starting to see, you know, the rebound in it. It's been giving us a lot of opportunities, and one of the good things about just understanding this is that every year there's something similar to that. You know, it could be one year it could be solar stocks, or one year it could be, you know, semiconductors, or whatever it could be. You know, for one, it could be social media stocks. There's always something in the market that's kind of doing this. And if you guys have ever seen me trade or Paul trade, what we end up doing is we have very concentrated positions towards sector momentum, and concentrated positions towards things that work. So like last year, you would have seen probably, I would say, more than half, but closer to 3/4 of all my trades in Amazon, Facebook, Netflix, Google, and a handful of other stocks, like commodity stocks, that I was shorting because it was in a downtrend. Versus this year, now we're doing, I would say, probably about 3/4 of our trades towards those. And I actually haven't, even though Amazon's been on a very nice trend, I've maybe taken a handful of trades in Amazon. I've taken more in Amazon, but a very few in Netflix, and none in Google, really, that I can remember of recently. So that's been, you know, just huge. Just, you know, there's always that rotation, and so you want to really, really focus in on where the money's going and what's trending. And Paul's going to talk about that in a little bit. But I'm going to be talking about a couple things that I do to kind of really find these type of trades, and then a simple day trading strategy that I use pretty much every single day that works really, really well. And so when you watch me trade, I would say I make 90% of my day trade income in the first hour, and a good chunk of it actually comes in the first half hour, using a handful of quick strategies. One is earnings breakouts and breakdowns, which is really a multi-day class in itself. And the other one is just using, you know, simple red to green moves and double tops that spike up at the open and things of that nature, which we'll start going into. But one of the things that I think is just an easy way to kind of spot, for me, when a stock could potentially start trending, or when a stock may actually finally come out of a weird zone where now you're going to have the wind at your back pushing it forward. And I'll tell you something, there's nothing worse in trading than trading a dead stock, a stock that's just like stuck. Because whenever you trade stocks that are just stuck in like a neutral range, you don't really have any rhyme or reason. What happens is the things that you use as a trend trader don't work. Meaning, like your moving averages really serve no purpose in a stock that's stuck in a neutral range because they're just flat too. You know, there's basic things like volume patterns and stuff that you can't read as well when a stock is stuck in neutral range because, you know, everything is just kind of diminished. And so one of the setups that I use to determine when a stock may potentially start trending, and we do this all the time when we're looking at earnings plays and also in these energy plays, is you know, what I call a base breakout, which is, you know, when a stock has been in a neutral range for an extended amount of time after a big downtrend. So this stock could be on a 1-year downtrend or a 6-month downtrend, but a very large downtrend. What you'll start to see is a stock will start to even out its pattern. And so what I mean by that is if you're looking at, like, say, hold on over here. If you're looking at, like, say, a stock like an OAS, right? So this is a stock that I day trade actually almost every day in some manner. But what you'll see about this stock is that, you know, in 2014, essentially, it peaked out at $58. Okay, so you're talking about it's come a long way. And you got this tremendous downtrend that's lasted a couple years. You know, this is about 1.5 years. Well, at some point, what will happen when you get a stock that's finally reached an equilibrium, but there's really nobody to sell left, is you'll start to see some bottoming action. And during those times, what you'll notice is that the volatility, the volume, this will all start to decrease, and you'll start to see a period where it starts to even out. So like you see an OAS in February where the volume is really about half as much as its usual average. And you really lost a lot of that range. You know, this stock used to have $1, $2, $3 range, and now you're, you know, got a 25-cent range, and you really start to even out here. And one of the things that I always look for is, you know, I keep an eye on moving averages. And so I'll look at the moving averages, and when they start to flatten, that tells me that this is something that I may want to start eyeballing for a potential rebound. And so we use moving averages for two different things, okay? So moving averages are used for a couple different things. One of them, the common thing is, you know, you can use them as guides for support and resistance. You know, stock spikes into a moving average. It could be a potential area to monitor price action more closely for a trade. The second thing that we monitor moving averages for is moving averages help us identify trends on particular time frames. And I use totally different moving averages for my day trading than I do when I'm looking at bigger picture stuff. When I'm looking at a bigger picture chart, you know, I use the 20-day moving average as my short-term moving average. And now I noticed that over the years, Paul has added in the 9-day EMA, but for the most part, because I'm day trading, the 20 will suffice unless I'm actually trying to get into
I've noticed
swing trade.
I've noticed over the past couple of years that the 20 is not as good of an indicator as it used to be. That when you get a trend, like something with OAS, it'll hold the 9 really well until it wants to break down.
Short-term pullback.
Yeah.
So when I'm looking at this, it's more of what I'm looking at is, are they starting to flatten out? You know, because that'll tell me that the selling has started to subside. You know, there's a few things that you can look at via just price to figure that out in terms of a bottoming pattern. But the easiest way, especially when you're new, is when you see your 20-day moving average and your 50-day moving average starting to flatten out, where the slope has been coming down really hot, that will tell you that, you know, after such a long downtrend, the trend may be evening out in terms of, you know, buyers and sellers are now reaching some type of equilibrium. So I don't use it as a trigger to make a trade, but just as a way to say, hey, this stock is starting to base out. From within the pattern, once you start to see the range contract and you start to see a series of, see, these are higher lows. Now, every time it pulls back, you're getting these higher lows. Well, that gives you a sign that potentially the bottom has been put in. And so now when you come out of your first base pattern, that could be the potential to start a new run, okay, to start a new run in a stock. And just because it comes out of it doesn't mean that a new run is going to start. But the first thing I'm always monitoring is, well, number one, I do like to play the breakout of this type of pattern. But once that first dip holds, once the first dip, that's the thing that I'm always monitoring, even when I'm day trading, is that first dip. Once that first dip in the stock holds and you get yourself another higher low, now I can say reasonably with some confidence that this might be something where I can start really trading it aggressively. And so once this happens, I'll be day trading these type of stocks pretty much till either the trend dies, but on a short-term basis, essentially what I'll do is I'll start trading them till they get really extended and overbought and become counter-trend shorts. You know, so once you break out, I got about 3 days. I notice you can give it a good 3 days before it starts getting so extended that you've got to start looking at it for the other way. That's the one. So you can see like a stock, even like a BCI. So this is why these oil stocks have been popping so hard, is because look at where they're coming from. You know, $60, and you're talking about really a 1.5 year, you know, pattern. So at some point, if this thing is gonna actually see, like it doesn't just happen in a moment. You know, oftentimes bottoms can take a little bit of time, but at some point you'll start to bottom out and build a range, and within that range you'll start making your higher lows. Your moving averages will start to flatten out. And so when you do that and you can come out of that zone, it can be a very, very powerful pattern that can go for months to even longer. And over time, you'll see, like, you know, even the best stocks will go through these type of patterns. You know, you've seen these big type of flushes in Netflix and Amazon where they're dormant for a long period of time. And then when they come out of it, they can start acting really, really explosive for a year. Paul, do you have an idea? Do you got a guesstimate on how long this can last?
It could last for a very long time. And those of you who know my story here, how I built my account in the mid to late 2000s, a lot of it was on the commodities run. And Kunal, if you could pull back that chart, you did a really nice job of showing how high it had been, like BCEI, where it was back in the mid-2000s. If you can pull that thing back even farther, you're going to see where it actually came from. And it basically came from where it is now. BCEI started actually a little higher, but a lot of these stocks were back where they were before that mid-2000s run. And I remember when that run started to break out and we were making these 100, 200% gains off those lows, you were hearing about, when I actually used to listen, I used to make the mistake of listening to CNBC and all that stuff. used to hear about people always talking about how extended it was. The run's going to be over. And, after that period, they still ran up, 1,000% from these lows here all the way to the high. So I'm getting some of that now where people will say to me, BCEI, it's made, what, 100, 200% run in the past month or two?
Which is nothing.
Which is nothing. If you look at that chart, if this is going to be a commodities run, we've got 1,000% we can get off this. So you can keep at it potentially for the next few years. Just keep going back. There's going to be pullbacks in here. There's going to be, some parts of it will be a little scary when it pulls back, but keep playing these setups within this trend and milking it as long as you can. And you can see here, I don't know what the time frame is. I'm guessing this is mid.
So yeah, this is actually, I just switched to EMES, which was another one where I actually traded this in my IRA. Ever see all these flags? I've been drawing trend lines on this thing for years. Like you can see all these
exactly.
trend
That's
lines.
What you want to be doing. So throughout this run, and it potentially, if we look at what's happening right now in the entire commodity space, it's exactly what was happening back in 2003, 2004, when we were just coming out of these bottoms here, which is fantastic for, and any type of style you trade, you want to be here, whether it's day trading. Kunal is just, every single day looking at these stocks, because these stocks that are in these multi-year trends that are becoming momentum stocks on a daily basis, they're also the most volatile. Then from a swing perspective, you're also getting these really quick trends. And if you're a position trader, a value investor, this is the time to be getting into these stocks. So I don't know about you, Kunal, but even in my longer-term accounts, I've been slowly building positions in commodities at this point where I didn't even look at them. I probably haven't added a commodity in my longer-term accounts for the last 4 or 5 years. And this was kind of
last
it's
year
very similar to real estate. It's the same thing. You want to buy when you see these depressed prices. Same thing with commodities here. So we've, it looks like 100, 200% move, but really it's nothing. If this actually is, the bottom here.
And so, guys, and there's always fake outs on these type of things. So it's like you could have like something like, I've been watching this U.S. Steel for a little while. This thing could come down. It could come down $5, $6 in a handful of weeks, because the market turns or something. But it doesn't necessarily mean that the bottom is not in, because look at where the bottom is, right? Sometimes when you have trends, you can trend for a few months, and then you get a couple little fake outs where you may have a big pullback, and then it may even out for a month, and then all of a sudden it can resume trends. Trends are never purely linear where they always just go up, 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 and make higher lows, higher lows, higher lows, higher lows, higher highs. At some point after a couple months, what you'll have is some, especially in these type of stocks that are higher beta, what you'll have is some sharp pullbacks where people all of a sudden start saying, I told you so, like, I told you so, and you may be watching on a CNBC, or you may be watching, Kramer or somebody, and they're like, I told you, like, see? I mean, this was just a short squeeze. They always say that's what it is, right? That's
why you want to turn that stuff off, yeah. That's exactly why you want to. Can you actually pull that X chart up? I was going to touch on this when I talk about swing trading them, but since you had them up right now, there are going to be some painful pullbacks, and we're kind of in one right now here. And that can't really deter you. You have to take your little shots. Part of being a good trader is we're also good risk managers. So we should be able to manage our risk on these pullbacks, take a few losses, but when it comes back up, be able to make a lot of money out of it. And what you want to kind of key in on is if you see on the move up here out of the breakout, when was that? In February.
Basically, yeah, end of February.
All that volume. You can see, if you just key in on that volume, you can see how the volume pattern has changed. And when we talk about money flow, that's exactly what we're talking about. Now we've got this really strong volume pattern, and what you want to be seeing on these deep, kind of painful pullbacks, you want to really watch the volume. It will dip up a little bit because there's some, panic in here. Some people are getting scared. They think the run is over. But as long as it's in check here. You're still seeing positive volume. You're not seeing a lot of selling, unless you start to see bars here like these first bars here. These are orderly as a volatile stock can be. That's still a pretty orderly pullback. So it's still something, rather than looking at this as the trend is over and we can play like a topping formation, we're actually looking to enter here on some kind of pullback signal, which we really, maybe today was it. Maybe this tail here, although I would have liked to see a little more volume to the upside. But we're looking for these kind of spots here to get in to the long side again.
And so, guys, when you're looking at volume patterns, as we always teach at class, how Paul taught me is accumulation distribution, right? So accumulation distribution. So when this thing came out of the break, this big push in volume, which is 3 or 4 times its daily average for numerous days, that assigns validity to this price move. So volume is never a buy signal in itself, but what volume does is it gives you a story. It gives you confirmation and assigns validity to a breakout. And so that volume coming in helps us understand that, hey, this is something significant because, well, first of all, these are the biggest volume days it's had really in, I don't even know, it looks like over a decade.
Yeah. And Kunal, can you kind of key in on now going back to 2015? And what you're going to see here is it's not only the current volume, but when we're swing trading, this becomes really important that we're trying to piggyback on what the big guys are doing. We always talk about money flow, and when we talk about money flow, we're really talking about not what you and I are doing. We're talking about what are these big guys doing. And there were indications in 2015, which is why we were able to jump on that bottoming formation so quickly, even though it was still a bit hard to tell in early 2016. But there were indications here. Look at August. You see that big spike up. And it's not going to bottom right away, but what this is telling you, and then you go back to September, you see another big spike. Then you go to October, November, you see a few more big spikes. And what this was telling you here is the big guys are starting to build positions. And, in that multi-year trend, they're seeing now, okay, this is the time to start buying. And once they have your back, you can kind of jump on it because they're in it. So that's where we started to key in and start to look for this bottom formation. This is when you start to see the turnarounds. You get these subtle indications much before here, which we saw in 2015. And we actually did take a few shots to see if it would bounce. But the strong bounce then came in 2016. But you're always going to see that before the actual big bottoming move.
And guys, just remember, use your moving averages, right? Look for higher lows within the range. You don't have to make it too complicated. And wait for it. And the thing to always remember about really any trade is that you don't have to be in, and oftentimes I'm not, in the initial move, the initial break. Like that may be something that you're not even taking a part of, and if you don't, it doesn't really matter, because if you're looking at something on a much bigger view of things, whether you miss the first 2 or 3 days has really no impact on how things are going to go for the next months, where you could participate over and over and over, because when trends are established, they can go for a time that's a lot longer than ever anticipated. One of the hardest things to do is, right, to get in front of a trend and figure out when it ends. They always go longer than you think, and so you never care if you miss. Oh, I missed the first day. Who cares? You missed the second day. Oh well, right? Because everything comes back at some point and will provide you with some type of entry. It's just a matter of being patient. The worst thing you can do is your stock runs up 3, 4, 5 days, and now you think you've missed it. Always remember, hey, these things can run for months sometimes, or longer. So let's get back into, before we hand it over to Paul for some his swing trade setups. I want to talk about a quick setup that I do every single day on the day trading side. And it's a very simple setup, and it comes usually right at the open. And so that's why I like to trade them. So almost every day within the first 30 minutes, I'm always up at least a couple $1,000. Like always have been for years and years and years. That open is where there's price volatility in stocks, where on a day trade basis, you can really, really make your gains. And so I break up as a day trader the market into 3 zones: the open, the middle, and the close. And so the open is about price volatility and price discovery. You know, stocks are trying to find out where it is. You know, so emotion comes in and momentum comes in, and stocks can overshoot or undershoot in a monstrous way. And then the middle of the day, which I consider after the first hour, that's where you get consolidation or retracement. So after your initial move on a stock, you're going to get either some type of consolidation or some type of retracement. You know, for me, that's usually kind of the chop zone of you're just going kind of counter to what happened at the open, or, you know, you're just playing a much smaller range. And then the end of the day, which I deem after lunch, that's your close, where stocks pick a side. You know, whether they're going to close strong or hot or, you know, cold or whatever it is. So that open, because it's about price discovery, you get these exaggerated moves. And so I use a red to green move or a green to red move as a trigger on numerous different patterns that we trade on a big picture. And so, you know, as you guys may know, Paul is my mentor. He taught me how to trade. And so I still use the patterns that he's taught me all these years ago. You know, flag breakouts, flat top breakouts, the rubber band setup, which is on the short side actually my most profitable pattern. And I still use those exact same patterns as swing trades, but I also take those big picture plays that he's taught me, and then I narrow it down on a day trade basis for entries too. And so a red to green move and a green to red move is a trigger. It's a trigger for a continuation play on a breakout from the previous day. So like a stock had a big price move, 5% or more previous day, it's on my watch list, and I may trade these at the open for a red to green move. Or if I see a really powerful daily pattern, like a flag pattern, and especially rubber bands, I use that trigger to enter my trade. Now, I enter these only as scalp trades because these are essentially for the open. So most of the trades could be 10 to 15 minutes long. It doesn't seem like much, but in those 10 to 15 minutes, that's when you could get 5–10% moves sometimes. You know, they work really well on the FANG stocks too, especially in Netflix and Amazon. They work really, really well. I watch the price action closely to see if a longer trade may materialize, which could be happen 1 out of 5 times. You get a home run where it just trends all day. But initially, it is meant to be a quick trade. And so what that means is I'm looking for stocks that were hot the previous day, you know, that had movement on heavy volume. These will often be stocks that had a PR, an earnings, or sector-related theme that put this stock into play. Okay, so it's a continuation play on the previous day. If a stock is parabolic, up or down, that could also be a way that I enter these stocks. So it's either continuation play or I'm going counter trend on these type of things. Okay, what I'm looking for is right at the open, some weakness in the stock for just a hot second, the first 5-minute candle, where it just dips down. And then when that dip is bought and the stock goes green, that's when I buy for my day trade. So as soon as it enters green. So essentially, so it could be something like this. So this is like a legacy. So this is a couple of weeks ago. These oil stocks were really, really hot. I use these on oils pretty much all the time. So end of May, you can see like this big run. See, LGCY came out of its base breakout. Okay, so it came out of this base breakout. So I'm already watching this because it's been dormant for a period of time. We've got your moving averages flatten out, and it's coming out of its base. So what you'll see here. Hold on, I got so many charts open. So what you'll see here is as it comes out of this base breakout, so the base breakout level was at 150 that you can see on its daily chart. So it's at 150. So now when it breaks over 150, it goes on a pretty big run up until $2.40. And so it had a really nice move. I don't even know what that is, 20, 30, 40%. Its first day of its base breakout. So now what that does is I've got a stock that's breaking out of my pattern. Remember we just talked about these base breakouts as longer term breakouts. So this is something that normally I can also swing trade. But I'm also going to be able to day trade them to the upside because the pattern is so explosive. It's a bottoming pattern. So the day after it breaks out, what I'm looking for at the open is, see how this stock closed about 220? Right at the open, you have a quick dip. See this one red candle? Just one small dip. And so what happens when this stock dips like that, just for even a hot second, people just assume the worst, and they say, oh my gosh, the trend is over. You know, false move, and people start to sell into it. And the stock will dip down real quick. But because the longer term play is so bullish, what will often happen is that initial dip, that first red candle right at the open, it gets bought up and the stock goes green. So the second it goes green, I'll buy the stock in expectation of a continuation of the previous day. And oftentimes your second day play can be, you know, as powerful as the original breakout. And so it's just very, very simple pattern. Quick dip, red, it goes green, we buy it, and then we're playing it to the upside. That's one of the best patterns that I will use at the open. And the same type of thing happens, you know, when we're going counter trend. So, you know, I also use that same type of pattern when I'm going counter trend. So like this nugget is something, me and Paul actually took the exact same trade. And when I see a stock go parabolic, meaning it's up 4 or 5 days in a row, and you see a stock that's up 1, 2, 3, 4 days in a row, okay, you get 4 days in a row, your stochastics will get overbought, meaning that, you know, this thing is already getting extended. And you can just tell by the eye test, right? A stock that's at $80, it gets to $120. Well, I'm not a mathematician here, but that is probably close to a 50% gain. So when this happens, I have a rubber band trade set up, you know, the way Paul taught me. And you can overlay Bollinger Bands and some other things if you really want. But at this point, you know, we can eyeball them. I don't know if, I don't need them anymore. But, you know, in the past I've used them. It's just common sense. Stocks tend to run in chunks for 3 to 5 days. Once that is over, they have retracements. Now, if you get a move that is so exaggerated to the upside, then that's when, and the only time I really go counter trend.
No, let me ask you here. So you're looking at this daily chart to get your intraday trade, right?
Yeah.
And I'm basically looking at the exact same thing for the swing. So as you were looking at that, I actually remember you were texting me about JNUG. We're looking at it exactly the same way for different time frame type trades. So I'm doing the same thing, exactly what you said. You know, usually on something like this, after the third day, I'm looking for the signal. You're never going to just jump in. You have to get the signal. But you start looking for it after the 3 days. 3 days, it could happen on the 8th day. You never know. But when I get that signal, I'm going to jump in short for a swing, like a parabolic short or a rubber band short. You've already done it on an intraday pattern. Now, do you ever, I've been experimenting with this kind of hybrid day swing type deals with something like this that's very extended. Usually I'll never mix the two. But with something like this, where you take, say, a quarter of it and say, you know what, this thing is so you know, it's so extended here, I could get that gap down, and I'm just taking a quarter. I can limit my risk here with just a quarter of it and just hold overnight and see if you can get that next day continuation.
I usually don't. I just do them in separate accounts. You know, one for day, one for swing. Only for the fact that it just kind of confuses me. But the other part is that, so like, you know, and talk about red to green moves, you know, you could do the opposite. So see how this stock gapped up? This is like your exhaustion gap. You know, when you have a rubber band trade, the last gap is your exhaustion gap. And so I want to see that gap. So as soon as that gap fades and it just goes green to red, meaning it's actually red on the day, I take the trade. And the reason, Paul, I don't keep...
You'll take it as a swing then, you just in your
yeah, but it'll be in different accounts. You know, for the day trade side, you know, because say I'm hitting this thing at 120. You know, that's where it was like 121 where it actually, 120 or so where it went red. So I may take this thing, say 1,000 shares of it, but, you know, if it spikes down to 116 in one candle, I mean, you're going to take a good chunk of it off. And the thing is, if you'll get stopped out a lot because you put your stop at your buy price. Yeah, it spiked back up to 121. So, you know, I will keep a quarter and just keep a stop, you know, somewhere because, you know, you might get stopped out. So I'll trade around it. So once the green to red triggers and you're covering into these flushes at the open, you know, all the spikes intraday, I'll be taking these things short if I see a setup, like a bear flag, simple stuff. Like, you know, this thing under 114 is essentially just a, right, I mean, you just, a break of support. I mean, it's a very simple setup. There's so many you can do, but I'll keep taking these things over and over. And then the thing to always remember is, you know, some people will see this kind of $10, $15 move to the downside, and they'll think, oh my gosh, this is over, and they take it off their watch list. But I did the exact same thing the next day. You know, this stock, see this, I want to see a small gap up. So the next day, this stock gaps up just a couple bucks.
Trading it right around that close.
Yeah, it gaps up just a couple dollars, and instantly, first candle, and I like it when it happens the first candle. Instantly, the first candle, it reverses and it goes red. So I'm already shorting this thing at like 113. You know, stock pops down to 108. It's cover, 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 cover. If it pops up and makes a lower high, well, now I have a little bit more confirmation. I can reload some, and then we just keep playing this thing to the downside. And at least when I'm day trading, you know, my rules, I'll get probably about a good, when you get a rubber band setup, probably a good 3 down days of safe day trading before you got to start worrying about, you know, the rebound, depending on how much it actually falls.
And that's exactly what happened with Nugget there. You got a really nice bounce. I think it was a couple of days later.
So guys, I'm going to hand the presentation over to Paul. He's going to go over some of the slides and some of the swing trading that he's been doing. Guys, you know, I'm a day trader, as you can see. You know, I'm trying to make $2,000, $3,000, $4,000 hot at the open. But what I do, you got to monitor it, right? I mean, we're talking about trading really volatile stocks where you can have moves of $5, $6, $7, $10 in a matter of 20, 30 minutes. And so it requires some babysitting. Paul runs our swing trade service at our site. And Paul also, when he mentored me, I had a desk job. You know, I was working as a recruiter. You know, he taught me how to get full-time results trading volatile and trending stocks. but doing it while I work so that I wouldn't get fired, but I also could do my work and I'd have to monitor it all the time. This is so many years ago. I used to monitor my 3 or 4 picks that I'd work on with Paul from my BlackBerry. Ameritrade had the worst BlackBerry app, but I think all apps were awful, that long ago. But BlackBerry was the hottest thing. There were no iPhones. There were no iPhones, so you had to go BlackBerry and use your little trackball and try to make trades. And so he runs our swing trade service, which is really good for part-time traders. But one of the things to really understand is that even if you're a part-time trader or a swing trader, it does not mean you can't get explosive results. I ended up quitting my job and opening Bulls on Wall Street, doing this type of stuff. I wasn't day trading at the office. I was swing trading. And of course, this time, the market was really wild and stuff, just similar to actually what it's now, where you can get those big chunks and you don't always have to be in front of the computer. So I'm going to toss this presentation over so you can see some of his slides. And Paul, why don't you show us what you got?
All right. Now, can you set this up? Okay. All right.
Hold on one second. Let me get you there it is.
Now, which screen is showing up here?
I see your GoToWebinar screen.
Okay.
Now we're back. So you got to hit share your screen.
Now you got the other screen?
Yeah, now we're back on mine.
All right, how's that?
Nope, we're in.
All right, perfect. Okay, swing trading. Yeah, and that's exactly how I did the same thing, mid-2000s. Basically grinded it out with a full-time job, and within 5 or 6 years, I was ready to break off full-time, and now I've expanded to some different things, but really still the base of what I do is swing trading. It's been a great market in 2016, especially if you know where to be. And what we're going to kind of go over today is how to know where to be. So, you could park your money in SPY and you would have made, a good 13%, 14%, whatever it is. But if you want to beat the market and really make these explosive type moves, and we're up over about 30% here, it's by knowing what sectors to be in, knowing where the money is flowing. And what I've been telling people lately is you could know nothing about setups. We spend all this time worrying about scans and setups and when to enter and when not to enter. If all you knew was this is the sector to be in, and you basically just had a dartboard and threw it with the dartboard and just picked anything, entered almost any time, you'd probably not only be making money, but still be beating the market. So this is the key to just about everything I do. It all starts from sector analysis. I did a couple of webinars in January and February, and I touched on this. A lot of you have been asking exactly how we do this sector analysis, because we keyed in on that commodities bottom breakout really early on as it was actually developing. So not just post-breakout as it's been trending now, but we actually caught it as it was developing. And part of that is through this sector analysis. Now I'm going to touch on it here, but if you really want to dig into it, and I know many of you are bootcamp members, and you can go in, you can keep checking these out every time Kunal does them, or if you're thinking about it, but you do more swing trading. Actually, next bootcamp, I'm going to be hitting swing for 3 days, and then we're going to see how it goes from there, and we might do a full class. So keep an eye out on that. Next time, we're going to do a swing lesson. I'll get deeper into this, but let's get started. So how do we identify a trend? Basically, that's through our sector analysis and money flow. And you guys are seeing my telechart here, right, Kunal?
Yep.
You can see when I flip back here, it's flipping back and forth.
Yeah.
All right, perfect. So what I do on a weekly basis is I'm taking, this is in telechart, whatever charting platform you use, you should be able to get to it. If you don't have any kind of paid services, you can just go to FinViz. They've got some good sector analysis there. I sort the sectors by 30 days. So I want to see over the last month, what are the top and bottom sectors? So if we look at right now, over the last 30 days, computer distribution is #1. This is actually only a few stocks, so it's really not meaningful. But you can see here silver, industrial metals, gold, coal, Oil and gas, so that's energy, utilities. This is what we're seeing here. It's basically made up of mostly commodities, which is telling you that's where you want to be. So we're not only looking at what's been hot over the last 30 days, we're looking at the price pattern, we're looking at the price action, we're looking at volume flow. So if we pull out, and I'm going to get out of the actual sectors here and pull up XLE because it illustrates it really nicely. Actually, I'll pull up USO. So oil goes with energy here. So if we go back to when we were doing the sector analysis back in 2015, and I alluded to it with the Steel Stock X when Kunal was going over that, we were in this multi-year downtrend. And on the daily here, I can only go back this far, but this was coming off 100. And we were in this downtrend. If you looked at the volume pattern, basically a lot of red and very little green. Now, 2015, we started to see a change in here. And that kind of piqued my interest. That doesn't mean I'm going to jump in right away, but we started to see some indications. And actually, let me pull up the monthly so you can get an idea here. You can just see where oil was coming from and where we were in here and what the volume was like on the sell-off. We had this huge volume on the sell-off and then years of essentially nothing. And then all of a sudden, 2015, it started to change right here. And this is what you want to be clued in on. Now when we step back and look, it looks so simple. But at the time, there was really, again, you go into CNBC or whatever, no one was bullish on it. And that's really the time you want to start thinking about these bottoming formations when everyone's kind of giving up. But if we go back here to the daily, these were some clues here that there's some position building going on in here. So what we want to do now is find when that reversal is going to be. And basically, we knew there was underlying buying, and now we're looking for some kind of capitulation event. And what that is those last sellers. You usually see that one last big sell-off, and we saw that in early 2016. So in the trade report, throughout this whole period, we kept talking about this on a weekly basis that there's been some buying in oil and commodities. We even took a few shots in here. Some of them worked, some didn't. But we knew at some point we're going to get that event that's going to give us the big bottoming formation and the big moves. And we finally got that in 2016. Once we saw that, we jumped. So whereas now after the fact, you see a lot of people trying to ride this trend here, we actually played through this, and this was a big portion of our wins here in 2016. So that's kind of how we identified the trend here. Now there's some deeper analysis that we'll go into in the boot camp, at the end of this month, early next month, where we can really dig into exactly how we identified it. But from a basic level here, that's basically what you're trying to see. You're trying to see where that bottoming formation is coming, where is the pain, where's the capitulation event. Then once you get that, you can play one of these bottoming formations. And as it's playing out, we can start to get a little more aggressive, and we got really aggressive when we broke this, the top of this bottoming formation here. So that's what we're doing. Sector analysis and money flow. And I think looking at this chart here, you can see very clearly now where the money is flowing. Now we can compare that to biotech. And biotech has been the hot sector over, geez, I don't know how many years now, 5 or 6 years, Kunal. But we had a lot of money flow into biotech, and now we've seen the opposite. Basically, we've seen that sector rotation Kunal was talking about, where, I'm sure the past few years, Kunal, you've been trading biotech like crazy, right?
That was it.
And now you're doing the exact same thing, but you're doing it with commodities instead of biotech. So you can see how important it is to know where the money is flowing. And it doesn't matter what you're doing, day trading, swing trading. It doesn't matter. You really have to have an understanding of this so you know where to be. I mean, if you're continuing to kind of beat a dead horse and trade biotech now, you're making it a lot harder on yourself. And we can see here, the money flow is gone. No one's in biotech right now. The money flow is in commodities, so that is where we want to be. And throughout this bottoming formation, now we kind of fine-tune it. We get the entries. We try to play it very exact. But if you're not even doing that, if you just knew that, okay, this is the money flow, I can enter anywhere in here. No matter where you entered in here, you're probably making money. So it's really key to understand that on kind of a swing time frame here. So that's sector analysis and money flow.
Well, the other thing I noticed with even the biotech, there was a period of time when the trend was just starting to bottom out in oil. You would literally see the correlation intraday when biotechs are selling off. Whether oil was going up or not, oil stocks are starting to catch a bid.
Yeah, and that inverse relationship, and that's how you kind of key in on that sector rotation. So sector analysis, money flow, really important. In these beaten down sectors, now we're looking at a lot of different things for sectors. It's not always bottoming formations or topping formations. You're looking for trends, shorter term stuff. But since commodities had been in this multi-year downtrend, we start keying in on these bottoming formations. And you can see very clearly USO here, the oil ETF, these W patterns. So you're looking for a W pattern. It's not voodoo. There actually is a reason these patterns are there. Part of it is here, you get that capitulation event. It's human psychology. You'll get a little bounce here, and when that bounce comes, right away there's going to be profit taking, and then you get a little sell-off. And it's usually that next move where you get the big move. That's why that W forms. So that's what we're looking for here. We're looking for some buying, some selling, and what you want to key in on is on that selling, you want to see less volume than there was on the buying. So we can see that very clearly here. USO, capitulation event, huge volume here on the down move. Then you get some nice volume here when it tried to bounce. And when it pulled back here, this was key. This is where we knew we could get really aggressive. Because when it did pull back here, it was on very low volume. And then bam, the next move here, big volume in here. So this is exactly what, when we talk about money flow, when we talk about bottoming formations, this is exactly what you want to see. Now, this bottoming formation is done. That doesn't mean the trade in oil is done, but the bottoming formation is over. Now we're in that second phase, and that's that first thrust kind of breakout trend of that bottoming formation. But still, you should go back and study this because this happens over and over again. At some point, we're going to rotate out of commodities into something else. Maybe back to biotech, and you'll see another bottoming formation in biotech. So study this pattern. This is really key here for your sector analysis. Now we're in that trend continuation mode, and that's actually what we're trading now. We're no longer trading off the bottom. We're actually in a trend here. So that's a really good thing. It's actually easier to trade. So as Kunal was saying earlier, don't ever feel like you've missed a move. There's always another move, especially if this is a multi-year kind of play here. You're going to have setup after setup after setup. So never think you're going to miss a move. And sometimes if you miss it to the upside, you can look for that short signal as we talked about with Nugget. If you feel like, and what usually happens, and sometimes it's kind of why we pull back at those points, with Nugget here, we'll just pull it up here. Some people miss this move in here. And as they miss this move, it keeps going up, and finally they just give up and say, okay, I'm going to get in here. And inevitably, that's where it pulls back. So you can play these shorts. I'm actually getting away from what I want to talk about here. But so sector analysis, bottoming formations, and trend continuation. And that's exactly where we are now. We're in the trend continuation phase. So in the trade report, that's what we're kind of keying in on now. We alluded to it in X, where X is pulling back now, and we're looking for that pullback entry. So let's talk about what to trade now. So we know the sector analysis. We've got an idea of the setup and the kind of bottoming formation pattern. We can talk a little more about trend continuation in the boot camp. But let's talk about what you want to trade. So there's a couple of things you can do. And it's great that you can do this now, which Kunal and I didn't have really access to in the mid-2000s, which makes it a lot easier. Remember that when we'd get a sector and we'd spend hours just poring over that sector trying to find the right stock. You don't have to really do that now. You can just pick the leveraged ETF, right? So, if we see USO is the sector oil is a sector we want to be in, we can go straight to UWTI, and right there we're going to get outsized gains. So let's compare XLE here, and I haven't done the math either, but XLE came off the bottom here, and it moved from 52 to 65, which is a fantastic move. What would that be, about 12 or 15%, somewhere in there?
Yeah.
Now we can look at ERX, which is a triple leveraged. This thing moved in that same period from 14 to 32. So you're talking about 100 and something % move just by taking the triple leveraged ETF. So you really don't have to go into the sector and find all these stocks. It's really helpful on a day trading basis because you get that extra volatility. But really here, you don't really need to be doing that. And if you are going to do that, you better pick the stock that's going to beat the leveraged ETF. Now, how do we do that? And Kunal has just shown you the stocks that have done that. He picked OAS. He picked BCEI. I don't know if you pulled up WLL. I know you trade that one. And a few others, SM. All of those, and you can see here, this is an easy way to do it on Telechart. I have this price volatility measure here. Now, if we look at XLE, the price volatility is 19. That's not very volatile. And we're swing traders, we're momentum traders, we want volatility. Now, if we go to ERX, you can see here 56. So that's a very volatile stock. That's why we got this 100% gain. Now, let's pick OAS. Let's look at that number there. We jump from 56 to 120. And then it reflects here in the price. We moved from 4 to about 11, which is what, close to a 200% move.
Yep.
So this is the type of thing you would want to trade if you're not going to trade the leverage ETF. Whereas if you traded something like, what everyone's watching, the BPs, the Chevrons, let's just pull Chevron up. Chart looks fantastic. It's made a huge run. On CNBC, they'll probably be raving about it. But it's only a 32 on that measure. It moved from 80 to 100. What is that, a 20% move? But you can see we could be making 100% moves. So you want to be, if you either play the leverage ETF or key in on the right stocks. And I've got a chart here where you can really see it. So XLE is up about 15% off its bottom. Versus ERX, which is up 50% off the bottom. CVX is right there with XLE at about 15 to 20%. And then you have OAS, which is up 100%. And at one point was up 120%. So you can see here, you want to be either in the leveraged ETF or the stock that's going to beat the leveraged ETF. If you pick something that's not going to move quite as well, you're basically just playing with the sector and with the market. Now, how do we figure these things out? We can look at things like what I like to key in on is the float, the amount of volume that's pushing the float, short interest. These are all factors. These low float stocks are the ones that are going to move. And actually in oil it's interesting because they aren't actually low floats, but they are lower floats than these really big stocks. So basically, essentially, it doesn't take as much volume to move them, which is why these things can run the way they do.
Yeah, I think SM is low float, but most of them are actually regular. Like SM is probably 50, 60 million.
So yeah, I guess within a sector, float is relative. So they are actually bigger floats, but they're not CVX, which is a 5 billion float or something like that. So
yeah, even some of the ones like KMI, the ones that moved pretty well for a while, they were all billion share floats. It was crazy.
Yeah, yeah. So leverage ETFs, you want to go with the volatile stocks. You can go with the safe stocks, but if you do, you're not going to crush it with the safe stocks. So you want to be in the volatile stocks or the leveraged ETFs. So all right, entries. I think we touched on that a little bit. Basically, you can come up with, we could probably come up with, 10 different entries, entry styles or setups. But really, within these trends, the setups aren't quite as important, and all you're really doing is looking for a breakout or a pullback. So let's key in on one of the stocks that I've been trading heavily, which is FCX. This is not an energy stocks, but it's in the commodity space, and Kunal alluded to it. They're all moving the same. You can see here I have these volume patterns. These are circled from these periods here. I didn't just add them on, and if you go back here, you're seeing the exact same thing where we saw position building here in 2015, and then we finally got the bottom pattern and the breakout. So you can see this is the line I had drawn here. When it broke through that line, this is where I entered back in February. Now playing within the trend here, We can come up with these fancy patterns, but all you have to do really is wait for a pullback, look for an entry signal like a candle that's holding a key level, and enter. And that's basically what we're doing now here. So with the deeper pullback we have here, now I did take a little shot in here on Friday to see if this holds, but generally you're looking for something like a pullback and like a candle we saw here. I entered within here as it pulled back to the 9, and it's really as simple as that. So we're trying to make things as simple as we can, and when you get one of these trends, this is really all you have to do. If you overthink it, you wait for the perfect entry, you wait for the perfect setup, you might even miss some moves here. So that's really all we're looking for: pullbacks, something signaling that it's gonna hold, and then entering at that point. So kind of what we alluded to here: focus less on timing and more on the place it is within the trend. So Kunal was talking about this. When it gets extended, then you want to pull out a little bit. And this not only goes to the stock you're trading, but also kind of your overall portfolio trade management type style. So, a month ago, I was in about 10 to 12 positions. And as this thing got more extended, we started to lighten up. We didn't get out completely because you never know when the trend is going to end. But we want to lighten up so when we do get caught in one of these pullbacks, it doesn't hurt quite as much. So you want to know where you are in the trend. You want to have a feel for how extended it is. And then you can kind of lighten up the portfolio or maybe your position size, start taking some profits. And when we talk about exit strategies here, we can talk about stop loss strategy, loose versus tight stops. And in these volatile markets, what a lot of traders end up doing is they're fearful of these volatile moves, and they place really tight stops. And what happens, Kunal, you know this, you get shaken out constantly, right? You're in this trend, and you just keep getting shaken out. So what you need to do here, and I've actually seen Kunal do this with some of his leverage ETF trades. I actually asked him about it. Hey, why are you taking such a small position? And he would say, yeah, I don't want to get shaken out here, and I don't want to increase my risk. So that's kind of the strategy we're using here. Take a smaller position size, and that's okay, because when you get the gains, they're going to be huge. So even with that smaller position size, it's all right. But try to use as loose of a stop as possible. So we can see this trend with FCX. It's been a huge trend, but within the trend, there are spots in here where people got shaken out, especially if you're using a really tight stop. The algos, the market makers, they know this. They know what everyone's doing. So you want to think about where is everybody placing their stops, and you want to go a little looser to that to try to hold on to that trade. Actually, I'm doing a little of that here with FCX, where
everybody wants a tight stop for some reason.
Everybody wants a tight stop.
People assume tight stop means you're really good at managing risk. But it's not really if you take a bunch of losses. Like
exactly.
Some of the worst traders I've seen, they're great at putting in tight stops, but they just lose so much that they're not really good risk managers.
What it boils down to is everyone's scared. It's fear, and you have fear of these bigger losses, which you have to think about it overall. If you're in a trend, sure, you might be increasing your risk. You might be loosening it up a little bit. But that gain, if you get it, is going to be huge. So you want to be able to play through it. And if you're still, if you don't want to increase your risk, just take a smaller position size. That's all right.
Go smaller. My biggest trade of this year, actually, was my last 50 shares of shorting DWTI. I got it like near $500 or something close to that on the rubber band setup. And I just had like 50 shares. Really, like.
I remember that. The reason I pointed that, I don't know if you remember, but last year you were trading, I think it was JNUG or something like that, or Nugget, and I know how big you trade sometimes, and you told me you only took like 100 shares. I'm like, what? You took 100 shares? That's it? And you're like, yeah. You still made what, 4,000 or 5,000 on it.
I made $6,000 on 50 shares of DWTI.
Yeah. So it's counterintuitive. You think when a stock is more volatile, I have to protect myself and go real tight. When actually that's the period where you have to take into account the volatility, the ATR, the average daily range. And think about that when you're placing your stops. So actually loosen it up a little bit. And again, make sure you decrease your position size, like Kunal was just talking about here, if you're going to do that. Now, for exit strategies, the biggest roadblock to people making money in these volatile, trending, momentum markets is their profit taking. And what happens is they get this little gain, they jump out right away because it feels like a big gain to them compared to what they were seeing before, but then they don't get to participate in some of these bigger moves. And it's tough to stick with some of these big moves because you don't want to give back your profit. It's human nature. We want to keep everything we have. So what you can do is do the multiple exits. And I've heard you talk about this, Kunal, where you'll take an exit, and just like you did with DWTI, then you leave that last quarter position there. And that thing, now that it's psychological here, where we feel like, okay, I've got my profit. Now I don't have to worry about it. I can let it play out because I know I've made some money on this. And then you can let that thing play out, and that'll often be your biggest gain, even though it's the smallest part of the trade. So think about these multiple exit positions. If you're up 10%, you don't have to get out of the whole thing. Through this trend here, well, I haven't been, my position sizes haven't been big enough where I can exit 4 or 5 times. But I've been taking half and half off. So I'll lock in that nice gain, move my stop up, and then just let that thing ride up and see if I can get a bigger gain.
And folks, when you're acting from a position of strength, then your behavior changes mentally. So when you scale out a little bit and pay yourself, now you've just paid your car note or this or whatever it is. But once you pay yourself, now you can relax a little bit and let the trade develop and the ebbs and flows of the stock do what it's supposed to do, because stocks aren't linear where they just go up, 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 up forever, even whether you're intraday or swing trading, right? There's a little bit of ebb and flow. You may get, even a really, really hot stock, you may get 2 big up days and then it rests for a day. And then you may get another big up day and then it pulls back for a day. And then you get another big up day. And there's a little bit of that ebb and flow to it. So when you pay yourself and then you raise your stop essentially to your buy price or wherever to limit your risk, now you are trading on the house. Now it's a casino trade. And so once you know that mentally, psychologically, you're able to relax a little bit, and the stock comes down a few percent, it's like, so what? Like, exactly. I've already paid myself.
So much of trading is that mental game where, a lot of people know what to do. There's a ton of people who know what to do, but very few can actually apply it because of all this mental stuff that comes into play. And you have to do things to help yourself with that, and this profit-taking type strategy is part of that. The other thing here is going back to the well. So, you've seen Kunal do this in his day trading. He keeps going back to those same stocks until it doesn't work anymore. And, there's this fear sometimes people have where, oh, it's gone up, and I'm going to take that loss if I keep doing this. That's fine. Don't think about that one loss. Think about all the money you made getting up to that loss. So, for instance, this year with swing, if you've been trading this correctly, you've made anywhere from 20 to 40% here on this move. Now, you can't fear giving up. Say you're at 40%. You can't fear going back down to 35 or 36%. That's going to happen. Like Kunal said, it's not linear. You're going to have a little pullback, but you got to keep yourself in the game and keep milking this for everything it has. Now, you're going to do it strategically. When it's extended to pull out here. But now we're looking for that next move. Either we get one of these breaks of the highs here, or we hold on the pullback and we can take a shot at entering. You're going to keep taking these shots until something fundamentally changes. And that's what we're going to talk about here when we talk about what's next. So we've talked about what's happened here and the way we've profited from the trend so far, but what's next? Now we're looking into the future. What are we actually looking at here? So we'll take FCX as an example here. So what I'm looking for is each one of these pullbacks has been a buy. You could buy any one of these pullbacks, and we're looking for an indication that one of these pullbacks is no longer going to be a buy. And we're keying in on volume. So if you start to see on these pullbacks a real uptick in volume. So right now, even though this has been, there's some fear here by looking at the price action, but this price action is actually natural. I mean, some guys have been holding here some from 4. They're sitting on 300% moves. They're going to take profits in here. That's natural. But what we don't want to see a mass sell-off. So if all of a sudden we see volume coming in where the buying was at, say, instead of here at 50, we see it here at 70, we see it here at 80, we see it here at 100, that's going to clue me in that, okay, maybe there's rotation somewhere else, and I need to start thinking about not buying these pullbacks anymore. So that's what you're going to look for. You're going to look at how price acts on the pullbacks, and you're going to key in on volume. And you can do this across the board with any of these commodity sectors here. So getting back to energy, it's the same thing. We've had this nice run. We've had good volume. Now on the pullback, maybe the price action doesn't look orderly, but actually the selling has been pretty good here to where we can think, okay, you know what? If it bounces back up here over these key moving averages, I can get back in. So for instance, in the trade report now, I'm only in 2 positions where I just, through this trend, I was in 10 to 12 positions. Now we've got extended, we've got this pullback, and now I'm just waiting for that signal to pounce again. And that signal will be for us here in most of these energy commodity related stocks, can these get back above the 9? If they can get back above the 9 here and the volume starts to flow, we'll look to get back in. So we can go through here, you know, basically every stock you look at. And this kind of shows you how important that sector analysis is. Just about every stock here is showing that same exact pattern. So anything else, Kunal?
No.
There's got to be a ton of questions.
Yeah. And guys, so you know, the good news that we have here is that Paul is gonna be helping us on this year's boot camp. So hold on one second. So Paul's going to be helping us on this year's boot camp, which is actually a first. So I've been doing these boot camps we're on boot camp 26. So I've been doing it for a long time of years. And, you know, we add in swing trading and day trading and all that, but our swing trading section has always been, it's been basically give or take a handful of the things that Paul taught me almost a decade ago. You know, we've added to it, but it hasn't just been the focus as I'm day trading. You know, and for me, it's just that's just what I'm good at. You know, now, and it's like I'm still a good swing trader, but I just like trading that first 30 minutes and doing what I do. And you know, we haven't put that much focus on it. So Paul's going to be coming in this boot camp and talking about and doing multiple classes on what he does, and so how you can make you know, some good monies, but not be at the computer all day. Because as you'll see, I mean, I'm the man when I'm day trading, but it's the wild, wild west. I mean, it's like you see me, I'm like, I'm buying 5,000. There's this, shorting 10,000 shares. This 2,000 is boom, 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 boom. I take 4 trades, and it might be like by the time you're even looking it up, sometimes I'm like, all right, guys, I made $5,000. I'm getting out of here. Like Friday, I made $7,000 at the open in, I don't know, 15 minutes, and I was in Lake Tahoe, dude. It's so early, I don't know how you do it. And I started drinking at 7 in the morning. I cracked open a beer, and I'm like, hey, man, that's fun times. Guys, I'm going to hang out with you for moral support. But it's fast. You know, you have to be at the computer to do that because that's where the volatility is. So, Paul, can you talk a little bit about what you might be discussing in the boot camp?
So in the boot camp, what we're going to do, we talked about this sector analysis. We kind of glossed over it, gave you a fundamental kind of overview. I'm going to do 3 days where on that first day, I'm going to dig in really in depth to what I do every single week when I get into sector analysis. I do this every week. It gives me a really good feel for the market, the money flow, where I should be. This is where almost my entire watch list. You know, I always get asked about scans. It really doesn't come from my scans. It comes from my sector analysis. About 80% of my watch list is from that. So we're going to dig into sector analysis and actually building that watch list that you're going to trade from. So we're going to do that on the first day. The second day, we're going to go over earnings breakouts. We've had some great breakouts this earnings season. We're going to go over some strategies on how to play earnings breakouts from a swing perspective. There'll be one short setup off the breakouts and a couple of long setups. So we'll hit that on day 2. So whereas that first day we're talking about this kind of overview of understanding the market, watch list building. The second day we're actually going to go over one of my favorite setups, the earnings breakouts. And then on the third day we're going to go over parabolic shorts. So, and that kind of can sometimes actually play out of the earnings breakouts or breakouts, where you get a fantastic breakout, you get a huge run, and then you can flip it and short it. And JNUG was a great example here of that. One of these parabolic short type setups. We're really going to dig in how you find them, how you trade them from a swing perspective. So 3 classes, 3 days, and you're going to learn a ton from this. 2 of my favorite setups, and then the basic foundation of everything I do with the sector analysis.
Sweet. By the way, that's the one I forgot. I entered this true as an earnings breakout a couple days ago. Is this an IPO stock? So I didn't wait for it to flag too much. I got like near 30. But
that is actually that's one of the exact setups we're going to go over on that day too.
I love this type of setup, especially
take a shot at that, because that is the exact setup, one of the exact setups we're going to go over.
This is my favorite, one of my favorite patterns in a bull market for swings. This is the go-to, because the consolidation can be pretty short. Like, it doesn't have to be. I was watching this MNST too, but it gapped today. Yeah, I've been watching it for some kind of, I was waiting for a couple more days, but it gapped today. This was a big earnings move also.
Yeah, makes it tough. Kind of similar to what Amazon did also.
Yeah, Amazon's up $20 today. I stared at it all day. It's a great day trader, but I just
one that is setting up as one of those high type flags is EDU. That's kind of setting up right there. Earnings breakout. It kind of goes hand in hand with our sector analysis too, because education stocks have been on fire.
Yeah, I actually had this on my list. The one thing this one, Paul, the one reason I took it off my list was, did you see what's happened with YY and some of these Chinese stocks? I don't know what the news is.
Yeah, that is actually, if it wasn't for the fact that it's China and education, I'd already be in that as kind of a pre-breakout.
Yeah, you got to go pre-breakout. I don't know what happened here. I didn't understand the news. There was something about Chinese delisting, but there was 7 or 8 stocks that did that, and I was just like, the contagion of sector analysis is it could be Chinese tech stocks or Chinese search engine stocks, but in the U.S., if a Chinese company has bad news, sooner or later it starts trickling, because those short sellers come out, and all it takes is one guy to write a stupid blog on Seeking Alpha, and before you know it, you wake up and your stock is down 50%.
Oh, yeah. Yep.
So guys, let me give you a little bit of rundown of the boot camp. So our boot camp is designed to take somebody from A to Z on everything we know. Day trading, swing trading, trends, scanning, the works. It's live classes. And so we teach class 4 days a week. And now class will probably be going for about 5 weeks. We'll probably have, give or take, about 20 live classes taught via webinar just like this. We have a course book. It's the Trading Bible. I mean, it's got everything that's in my brain in this course book. Charts, examples, stories, anything you can think of is in this book. You carry that thing around your backpack and you go for it. We have a private community, a Bows community, a Bulls on Wall Street community, where all our students hang out and they can chit-chat with each other. They can do hangouts. They share their homework, their stories. They can ask for help. All of that comes in. We do Q&A after every single class. As long as it takes, really. I mean, oftentimes the Q&A can be as long as class, depending on how inquisitive our students are. And then, really, the fun part of class really starts. That's your book knowledge. And let me just tell you something from just somebody that's kind of always been a self-help junkie my whole life, in terms of hacking anything. you can't learn anything from books, not trading books, that's for sure. You ever read like that Sam Bernstein's like trend trading book? I mean, it's dense.
Yeah, I get that all the time too. Can you recommend any books? And you've got to experience it. And that's what's so great about this boot camp you've set up here. It's just
Try
you get
reading
about a year or
Trading
two
in the
worth of
Zone.
experience right in 60 days.
Try reading Trading in the Zone and tell me you can stay awake more than 10 pages. I mean, it's hard, and it's
Yeah.
actually very dense, and it's hard to retain. Sometimes you just need somebody to be like, this is kind of what happens when things screw up. This is how you're going to feel. Or when one of my students says, hey, man, I'm about to quit my job and start trading, and I ask them, how much money do you save? What do you have for backup? How many months of savings do you have? I start asking all these personal questions. Say, why would you do that? Because I know what's about to happen if you don't have these things set up. You know, you don't just quit your job. You quit your job when you have X, Y, Z all set up and your system perfected. And so, you know, that's where you really need to learn. But after boot camp, what we start doing is I give a screen share access to all my students while I'm trading. It's like while I'm trading, I literally have my trading platform up, and I go in, and we talk about the trades. So like today I only took a few trades, but like we'll go in, and they'll see me. I'll be calling out my trades, and you know, I'm buying this, I'm buying that, whatever it might be, okay? And we go through it. I walk them through it, and I get on like 15 minutes before the market opens, and we talk about the game plan. Because you can learn anything from books, but you're going to retain very little. Then even when you have a class like ours, and we're teaching you live, you're going to retain more, but there's a disconnect. And this is in anything in learning, where you can read it, you can see it, but there's always a disconnect when it happens live, in real time. You know, that's a little bit different because when you see something static in a webinar, it looks so damn easy. It looks so easy. But then when you're live and the lights are flickering, you have to be taught and shown what to look for, what you're seeing. And that's where our screen share comes in, and you know, all our students have access to them so they can watch me trade. And the other part that's what's really going to be helpful, I think, is just the confidence of when you go out and actually see people go out and do it every day, the good, the bad, the ugly. You know, a couple of weeks ago I lost. You know, I had days where I lost $1,000, $5,000. You know, it wasn't pretty for a week. You know, I lost $7,000, $8,000. Then the next week I came back, I only traded 3 days, I made $20,000. But the fact you can see all of that, and how do you come back from those losses? That's where you start to gain the confidence that, hey, I can actually go out and do this. I'm seeing it in real time. Like he's clicking these buttons. He's playing the patterns that he teaches in class. And that's going to be huge. And from there, we start doing trade recap sessions where, you know, we'll take all the trades I did for the day and we reverse engineer them. And hopefully Paul will jump in for a few and talk about his, and we'll reverse engineer them. You know, this is why we bought it. This was the pattern. This is how we found it. This is what we did right, and this is what we did wrong. And that is really, really important because, you know, even in our best trades, there are still things we could have done a lot better. It could have been either a little bit of a better entry, it could have been a better sell, it could have been a better position sizing. You know, there's always a few tweaks to make it, you know, from an A trade to an A+ trade even, or an F trade, and to at least something good. You know, there's all those things that we have to talk about, and so we reverse engineer all those things so that you can start understanding why we took it. And then we put the students on trading simulators. So we use a company that has a trading simulator. It's pretty good. A lot of the students will just use Thinkorswim, or, you know, Interactive Brokers even has one, where they can go in and they start simulating what they see. And we have a website and a program we use where the students can log in their trades. They can log in their trades, and it shows them in graphical format of what that chart looked like during that day, the daily chart and the intraday chart. So we can see right where they bought and sold. And the students can all look at each other's trades. They leave each other comments. The other thing that can happen is when they tag us with it, now we can look at the trades. If somebody says, man, I need Kunal to look at this trade, tags the trade, now I can take a look. And so now you're going to get the feedback you need on what you did right and what you did wrong, which is really sometimes, I think the trade reviews with students is probably some of the most, at least when I did one-on-one coaching and when Paul coached me, I thought that was really some of the most helpful stuff of, you know, me sending him my trading journal and he's like, dude, what were like these three? I'm like, I don't know. I'm like, I don't know.
And, you know, the other great thing is what you were kind of alluding to there is a lot of times there's no big mistake someone's making. It's an accumulation of these little mistakes. And if you have someone pointing that out to you that maybe you wouldn't catch on your own, that can be almost more valuable than anything else.
Yeah, I agree. So, guys, we start this, what's it, May 23rd? So we started May 23rd. It's $2,500 if you pay in full. We have payment plans. And one of the things that is probably different about you know, our company in general versus any other one is that we have a lot of traders that work for us and do different stuff. So when people need help, we got a lot of people that know trading. You know, Jordan, who made the slides today for me and Paul and helps us with all sorts of stuff, Jordan was one of my students. You know, Jordan has worked for me for years, and he also swing trades, and he also was taught one-on-one by me. Chai, who's another Indian kid that works behind the scenes and administering the boot camp and doing the emails and stuff like that, I worked with him for a year, you know, and so all of our members that work at our company, Saeed, who monitors our chat room with me, you know, another Indian guy, he also is a trader, and so we have I can't know of any other companies that do what we do that actually have, you know, a whole group of traders that actually really follow the same system, which is just the stuff that Paul taught me years ago, that actually have an understanding of it. So when you talk to an employee of my company, they know exactly what we're doing. So I'm going to open this thing up to some questions, Paul. We got some good questions over here, and
all right.
Joining me, it's been a little bit too long. I feel like we haven't done one for a while.
Yeah, we'll do more of these.
All right, let's go. Dun, 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 dun. Mark McIntyre, do these stocks have options? Probably most of them. I mean, options trading is a whole different ballgame, which I've never figured out. But
you know, I will say for guys in the daily, in the swing report, there are a number of traders. I don't trade options. I did in the past, but no longer do. But I get emails all the time from guys who are trading options using those swing alerts and are doing really well. I can't speak to it. I'm not going to give you advice on the strategies to use, but they're able to convert the swing strategies into good options trades.
And if you have an understanding, then it's like you can marry. You know, all good traders, you know, at least from what I know, every great trader has a unique perspective on the market that's their own. You know, no matter who's their teacher, what system they follow, they all have their own unique way of doing it. And I've also seen some people use these weekly options. Up to me, I can't mentally wrap my head around it sometimes, and so I stay away. I feel like I've barely mastered stocks sometimes. You know, like sometimes
there's just so many more layers you're adding in terms of time frames and strike prices, and
it confuses me. I just want to look at charts. Like that's what I like to do.
Yeah.
All right, let's see. I've noticed that the ATRs on stocks go up once they start trending. WLX, CNX, SWN. David, yes, that's true, because when a stock is sitting there, you know, you're just not going to have any range to it. But once you come out of range, it opens up. Even your Bollinger Bands will be really contracted, when a stock is consolidating. But once it breaks, I mean, everything kind of opens up.
And when you are swing trading, you want to pay attention to, you do want to pay attention to the ATR, especially for stop placement, kind of getting an idea of that. But what's really more important is the trend volatility, not the daily range for swing. So something like this measure here, which is measuring more of the trend rather than the daily moves, is probably more significant, although they do go hand in hand.
A couple people asked, Paul, what's your average hold time on your swings?
It really changes. I couldn't say I could give an average. Like, we talked about this before. In 2015, I might be holding something for 2 or 3 days, or just going for these really tight gains. Whereas one of my energy plays this year was 2 months. So the answer I always give is 2 days to a few months. And it can be like anywhere in between there.
And even in boot camp class, I've always just defined swing trading 2 to 14 days just to give it some parameters, but it's really anything that's not a day trade.
I would say the only time you really need to worry about that, I can enter a thing, say today, and I don't care if it happens, wherever my target is, 3 or 4 days from now or a month from now. But where it does get a little important, and I've gotten bitten by this a few times, if you use one of those leveraged ETFs and you have to worry about some of the price decay, at that point you might have to worry a little about how long you're actually going to be holding it. But other than that, I really am not worried too much about the whole time.
You guys, on price decay on leverage ETFs, leverage ETFs were initially just meant for day trading because the leverage isn't, if you have 2 different stocks at different prices and they go up 2%, then down 5%, then up 2%, what you start to see is some discrepancy, and over time it can actually add up to a lot so you don't invest in them. But if you're talking about 3 to 5 day bursts, which is, when you take like a good stock like an FCX or something, like say FCX starts bouncing tomorrow, it'll probably run 3 to 5 days before it pulls back. That's kind of, it's been its nature. You get those like nice few days of real burst. You won't notice, decay and stuff like that because it's just, first of all, you don't have enough money to really, it's not like you have $1 million in it where like 3 or 4% would matter.
Yeah.
But if you're holding for multiple months, it will matter. Jordan, I told Jordan was holding a UCO, UCO.
Yeah, I'm actually in that right now. Yeah.
He bought it at $12 for an investment, and he didn't realize it. He didn't realize there's a difference between UCO and USO.
Yeah, yeah.
And so he got it at 12, but oil was at $30. And now it's at 10 or something, and oil's at $45.
Yeah, because of that price decay. So what I do with that
is, price decay.
Well, for instance, right? I was trading UWTI before because I felt like there were going to be explosive moves, and I didn't have to worry about the price decay. This time I'm in UCO right now, and I don't know how long I'm going to have to hold it here. So I went with, instead of 3 times leverage, which you'd get more price decay, I went with the 2 times leverage. I can't do USO. You're just not going to make enough with it.
Yeah, you won't make enough.
But when I'm taking longer term positions, I am using USO. But for swing, it's one of those two based on how explosive I think the move can be.
And if it's just a handful of days, no big deal. But if it ends up being a month, then you may notice. You may notice a little bit of decay, but you'll still be more leveraged than the actual commodity. So it's like even if you hold it for a couple weeks, if oil moved 10%, it theoretically will still move more than oil.
So you get 25 instead of 30. That's all right.
You'll lose a few percent here and there. Hey Amy, so Amy's asking, how do you know the leverage amount? So Amy, whatever your charting platform is or Yahoo Finance, it'll tell you like 3x long crude or ProShares Ultra. So when you're looking at ETS, anything that says Ultra is a 2x, and then the rest of them are just 1x. So there's 1x, 2x, and 3x. I'm waiting for the day now that speculation's kind of coming back in the markets. The market's been a little bit kind conservative of recent after 2008.
Oh
But
yeah, yeah.
you're seeing speculation in number one in real estate. Look at the real estate in San Diego.
Oh,
I hope you're
jeez.
renting. I hope
Yeah, yeah.
but I suspect that we might see forex ETFs
Yeah,
someday.
I wish I could short the market. I don't know. How do you short a real estate market? I would like to do that here in San Diego. I think it's a little bit
It's
of a bubble here.
nuts. My
Yeah.
buddy Cameron Foose, I mean, he lives in San Diego. He lives in, I think, Mission Beach or Pacific Beach. He pays
Yeah.
like 58. He pays $5,800 for a two-bedroom place. I mean, it's really nice, but
Jeez.
in the
Yeah.
end, it's still two bedrooms.
Yeah. Yeah.
Whew. But you can't beat the weather and everything else. He tells me the same thing. He's like, man, it's like I can move to Florida and hang out in the swamps with you and sweat it out. Well,
You're paying for the lifestyle. You're paying for the
you pay to
lifestyle.
play. You're paying to play. All right, then a couple of people asked, is there a particular name of that volatility indicator you use?
It's just called price volatility. Yeah, you can just right-click IntelliChart, hit Edit Toolbar, and go to price volatility.
So right here, guys, you just edit it, and then you just add a row.
You can do a search in there. Just type in price volatility. It'll pop right up.
Dun, 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 dun. So you put it here, and see that? You guys got all these little things you can add. Telechart's pretty cool. I wish I had invented it. A few people have asked, do you ever trading stocks under $10? Because a lot of stocks, energy stocks.
I used to have a rule where I would trade under $10. I don't worry about it so much now unless it's a $1 or $2 stock. But the thing we just saw with energy, these things are still high float big companies that just got beaten down so much they became $3 and $4 stocks, but they still have like 500 million floats. So it's not like your average penny stock that's just a junk stock at $2 or $3. So for that on a swing trade, I'll make exceptions versus something I know that might be a biotech junk stock at $2, which I'd probably hold off on trading for a more conservative swing type style.
Hey George, a couple people have asked about this, Paul. Would you buy a small position and then increase it on confirmation? Say like FCX, you buy 500 shares at the 50-day moving average, and then if it confirms, you buy 500 more, hypothetically.
When I'm taking these feelers, when it's not based on a real setup, generally I'm taking the position size I want. And I'll exit out, and then if I get another setup, I'll just add to it again. But in something like this, with FCX recently, this was basically a feeler position. So it was a smaller position, really not giving us a great signal either way. I just felt like it was a pullback. I could try it out. If I take a small loss, big deal. But now if it does, what we talked about, if these break the 9, I'll get aggressive, and I can do one of two things. I can either add to FCX, or I can just take one of 100 other stocks doing the exact same thing, essentially almost like adding to this position.
All right, all right. Dun, 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 dun. Jason. How many months does the boot camp go? So the boot camp will run about 2 months, and then you have lifetime access. So our students, once they're in the program, we'll have students show up on May 23rd that took boot camp number 1. Actually, probably not boot camp number 1, boot camp number 2. Boot camp number 1 only had 11 people, and they're actually all pretty good traders. 2 of them still pop by, but Chris and Tim. But the rest of them, they're tired of me. Boot camp 1 I was really intense because, it was the first one. And I told the guys the first one, I said, guys, what we lack for polish, I'm going to make up with effort because, we didn't know anything about slides or schedules. I mean, we're texting the group like, hey, class is late 15 minutes. I can't get my webinar working. Like, it was just like this huge hot mess of stuff. But I was really hands-on with that group, so I really beat them down and everybody was really tired of me for a while. It actually went from 16 classes to like 26 because I wanted to make sure they knew it, and they actually were at the end were like, dude, class has got to end. They're like, I think we can.
What is it on right now? What boot camp is this?
This will be boot camp 26.
Oh wow.
So we've been doing it for a little bit of time. Hey, a couple people asked, like, can you kind of detail in what your swing service is about? So let me pull up the module page. And Paul can talk a little bit about.
Basically, you're getting exactly what I do. This is based off my own trading. It's my own trades. So that nightly research that I'm doing, these sector analysis I'm doing, going through my watch lists, the focus list, you're getting all that. If you have a full-time job, it's great because you don't have to spend hours yourself analyzing the market. You're going to get a good feel of the market just listening to me every day. So there's a 5 to 10 minute video. That's the meat of it. If you can just spend 10 minutes a day just listening, you have a good feel for what to do the next day. I'll have my focus list in there, the current positions that I'm in, and anything else I want to talk about. Most of it will be in the video. And then during the day, you're going to get alerts. So if I do make a trade, I send an alert out right away, whether I'm entering, whether I'm exiting. If you see here, Kunal has it posted up. You can see recent trade notifications here for trades we've made. Sometimes I'll put in a note in there. It's not an actual trade, but it's something related to the trade we're in, something I've adjusted, my thoughts on the market. I might do an intraday video, and then you have access to the previous posts. So you're going to get that every day, so 5 days a week. And by doing that, you'll get a really good feel for the market. If you're a part-time trader, you can go by the alerts. I'd recommend you know what you're doing and listen to the videos. You're making your decisions on your own. But then, you get the Mondays are really good also, where we kind of lay out what we're looking to do for the week. So just listening to me, the comment I get a lot of is, that first week, it's kind of information overload. And I get a lot of questions. Then I'll get start to get comments after a month that, hey, everything's kind of coming together and I really understand what you're doing. So it's almost like an educational tool as well. While it's not just trade alerts, it's not just a focus list. Every day in the videos, we're kind of going over and kind of teaching as well.
And guys, we run big deals, about 50% off on annuals for the swing alerts too. So, if you think about subscribing to the swing alerts, we have annuals. If you have any questions, just hit us up on the live chat, and we'll give you a call, or you can set up whatever you'd like, and we'll make sure you get the information you need. Dun, 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 dun. When do you get on the simulator? During boot camp. So in boot camp, well, once the live classes are done, I prefer the people to use the simulator. A lot of times people want to use a simulator right away, but if you don't know what we're talking about yet, or you just don't know the methodology, then we're all just wasting time because we're grading trades that really have nothing to do with what we're trying to teach. There's just that disconnect. And the other thing I ask my students, I learned this in boot camp too, where I had like 5 Indians in boot camp 2. I learned a valuable lesson. There's no trading during boot camp. No trading during boot camp. Live trading. If you're taking some swing alerts, it's a lot safer than day trading. Day trading, there's no day trading. Because there's nothing worse than losing a bunch of money during the day, coming home, and then turning on the computer and trying to learn with some excitement, and take notes and do the things that you have to do after you just had this awful day. For me, I don't even like teaching class after I lose. So I always make sure, like during boot camp, 5 games, I just lock it in. Because if I had a big loss, imagine losing like $10,000, $15,000. How excited are you going to be to teach for 3 hours? And how excited would you be to listen for 3 hours if you lost that type of money? We had that in boot camp too. I let the guys run a little bit of rush shot. We had a bunch of Indians in there. And the Indians, what happens is you learn a new trick, and they want to make money right away. So they learn one setup. Like I could just talk about flat top breakouts, Paul. Next day, they're out trying these flat top breakouts. And it's like, oh my gosh, we haven't even talked about risk management yet, or like I just, what I do is like I talk about the patterns first, and then I go into the risk management after I'm done with the patterns, in terms of sizing and all that. It ended up being horrific. So no trading, no day trading during boot camp. You'll be a hot wreck if you lose a bunch of money. And this is hard. I would say, I mean, trading is one of the toughest things that you're ever going to learn to do, because it is totally dependent on you at some point. And that's what makes it awesome, but that's what also kind of makes it suck, because like I know when I lose in day trading, it's like I either sized up too big, I held something past my stop loss, I chased something too far off support, that's usually the one that kind of gets me sometimes. If day trading is going really fast and you know something is so hot and you get it too far off support though, because then the first retracement you end up selling it, but that retracement is really your ad spot. But because when your entry is wrong, all your risk management is off. Risk management is solely based sometimes off getting the proper entry, because if you don't have it, everything else is out of whack.
You're pretty much in no man's land there. And when you're day trading, that stuff, those little mistakes can compound so fast.
10 cents, 50 cents, 20 cents, and before you know it, you're like,
some paper trading or simulated type trading first.
So that's the awesome part about day trading, guys, and the bad part, because it's nice to be able to blame somebody else, but you kind of can't when you're trading. Hey, Nargis, I don't have any specific dates yet of when we're kind of going to situate it. We're still working on a proper schedule for that. So Paul P. So Paul's asking guys on like kind of where the focus is on the boot camp in terms of like how we do our schedule. So Paul, I'm a firm believer that all good day trades come off explosive charts from the daily. Like I won't buy a stock that's hot or acting hot if the daily stinks. So like like yesterday, like some of my students were looking at this 8ZNP. See how like it gapped off this bottom? Everybody's like, oh my gosh, like this thing is so hot, we've got to day trade it. And I said no, because it's not really a swing setup, it's not a breakaway gap, it's not something that we'd want, right? So all it does is it gaps up on this hot earnings or whatever it could be, I don't even know. It just hits the 50-day moving average and then it comes back down, because you're not aligning on multiple time frames. And so everything that we do is based off the bigger picture. So we start in the beginning on how you set up the charts and what are trends, what support and resistance, and we work at the big picture stuff, and then we start to narrow it down into the smaller stuff. And so that's always been kind of my belief on teaching is, you start broad and then you narrow it down, because you just can't be even a good day trader unless you actually understand what's looking good on these dailies. Otherwise, you just end up buying these gaps like HCNP. Look at this big junker. Like, this happens a lot. People are just trying to see an earnings gap or something and think that's good, but it's all in context of, I like them to be coming out of, I like the patterns like Monster, where it's ripping over multiple moving average. It's like a breakaway gap. I like something like True, where, you have an IPO and a low float and a relatively new stock, and it's breaking away clean. Like, these are the type of gaps that I like to play, and so everything starts off on the big picture.
I mean, you can totally see the difference there between HCNP. One's breaking within a range, really hasn't gone anywhere, where this is just has clear selling.
Yeah, I mean, that's the whole ball game. I mean, that's what can make a good trade. If you can't align on multiple time frames when you're day trading, your day trade is worth nothing, because without the wind at your back, what are you really doing? You can't reasonably say if a flag is going to work unless you're actually trading within a trend and proper formation. And what do you think about SGY? So this is a penny stock, and to me, if this thing can't bounce, well, first of all, it's 60 cents, so there's a good shot it just goes to zero. Usually once you get under that kind of dollar spot, there's a good shot it kind of can drift back down to zero. But
The other thing here is this is an oil and gas stock.
And it's not going.
And it's like there's so many good ones. Why would you waste your time with this? So just look for the ones, get in this space and look for some of those other ones we've been talking about here. I know sometimes a lot of people see the 63 cents and you think you can load up on shares, but if it's not going to give you that move, you probably want to go somewhere else.
A couple of people have asked about stops. Do you use percentage stops or price points? So I use support and resistance. I mean, that's how I pick my.
Yeah, I mean, it's a number of factors coming in. You have to think about your position size, how much you can risk of your own account. You're looking at support and resistance. You're looking at the volatility of the stock. I think that's one of the most important things. You need to know how volatile that stock is. And then I'm always thinking about stop gunning. Where is everyone else placing their stops? And I always say make it as loose as you can within your risk parameters. So if you know, like just using this pattern here, if you were buying that SGY at the lows there, everyone is going to have their stop just a little below that. So you want to try to get a little wider.
Hey, Casey Davis, I didn't properly understand your question in terms of is it a webinar or system? If you could elaborate. Mr. McNabb, how do you set price targets to take profits? So that's a whole system in itself, but just kind of a layman's way of just an offshoot of some things I look for is the stock getting parabolically extended to the upside? If my whole time was meant to be short, is it hitting levels of resistance? Am I getting X levels of my risk? Maybe I risked $1 and I already have $10. Might want to take some off. I've paid myself properly for my risk. There's a whole different way of looking at things that's a little bit dynamic. What I usually use, I have a reasons to sell list. So like I have a list of reasons that I may sell a stock based on intraday and dailies and the different things I look at, from a stock that no longer is making higher highs and higher lows to a stock that's breaking its moving averages. There's so many different things you can look. But having kind of a dynamic list like that is helpful because your sell reasons will change according to market conditions also. How I handle a distribution market, I sell very, very different than how I'd be selling the last 1 month. Completely opposite. Also my entries also change a little bit in distribution versus how I trade, how I would change now in terms of how far I'm willing to chase something and, anything. So it's a little bit dynamic, but I use a little bit of those type of things of, support, resistance, overextensions, and, have some basic parameters that you can follow. Molly, when you miss a stop and the stock drops $2, should you wait it out? Paul?
Yeah, what I'll do is if you miss a stop, I think what she's talking about is like when it gaps below your stop, right?
Yep.
And that's, we call it the gap down strategy. Basically, what you don't want to do at that point is just jump out right away, unless you have to. I mean, if you can't monitor it, if you have to have a hard stop in. But if you can be watching it, I like to give it a little bit of room because gap downs can often be overreactions to some news event, to some fear, whatever it is, and you'll see a gap down, maybe a little bit of a continuation, and then it'll come right back up. So I try to hold through that a little bit. Obviously, if it continues a little too much, you've got to get out at some point. So if your risk gets too big, but in the morning, for say we've got a swing on, it gaps below our stop, I won't jump out right away. I'll kind of wait to see how it plays out. And
me too, especially if it's a trending stock, because like we just talked about red to greens, right? Sometimes that small gap down is actually a buy opportunity. That small light gap down, it just happens for like one candle. And it's like, boom, it just drops 3%, and you're like, whoa, 3%. And then in 2 more seconds, that dip is bought, and it goes green, and you're off to the races. And so in the morning, like even my IRAs, I look at all my positions, and then I'll either readjust my stops, or depending on where the market's opening and where the gaps are, because that sometimes it's just a quick thing. And remember, the open is about just price volatility. What happens in a lot of these stocks too, because say a stock like GWPH, or there's a lot of different ones that we trade, but somebody could at the open market order 5,000 shares of some random stock we're all in, and they could knock it down 10 cents, and you'd be like, whoa, and then in reality, but there's just no volume because it just opened. Something like Yelp. Yelp is a really thin stock I haven't traded this forever, but now it's on my list because this big move. This is the kind of earnings.
We got that earnings breakout, yeah.
But Yelp is really thin sometimes. Like at the open, you may see this thing just drop down 30, 40 cents because it's just a little bit more thin. You wouldn't think so, but it just it is. That's how it's always traded. So you got to give it a little bit of room. Did you see that article today on CNBC? Double your money on a 1% SPY bounce. I didn't, but I'm also not a big reader in financial spaces. I like reading some blogs like the Kirk Report, and there's some basic ones that I read. But I haven't been reading much of the CNBC stuff. Mr. Frame, for red to green moves, what time frame do you trade on? Mr. Roberts, so I always use 5-minute charts intraday. What I will say is that the red to green move doesn't really change depending on how many candles or what kind of candles you use, because it's a matter of price, not candles. I'm looking for that quick dip and then green. So it's a matter of price versus candles. Dun, 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 dun. Loyal chatter, remember, how did you net $7,000 in gains on Friday? Those were actually all red to green moves. It was literally all red to green moves, Mark. It was, it wasn't Friday. It was this particular day here. I think that you're talking about. Oh, yeah, that would have been Friday. So May 6th. So EPE had a gap up, and then it was just up a lot the previous day. So it triggered it on watch, and it broke over the 200-day moving average. So to me, that was a big thing. So as soon as this stock dipped right at the open, see how it got down to 570? As soon as it went green at 590, I bought, I think, 5,000 shares. And first candle, I laid off half. The next spike, I just laid off, another 1,000. Then I scaled out like 500, 500, 500. I think I got out most of mine like 650, something like that. But it's quick and easy. I only held it for like a handful of minutes. I didn't have to buy that many shares. That's my favorite type of trade at the open. Big momentum push, light open, and then take it down. Hey, Paul, just a couple more questions here.
All right.
Paul's daughter has asked me not to keep him around for 4 hours.
Well, you know what happened last time? Actually, I'm in their room this time. Last time I told them to stay in their room, and I think it was the first time. This might have been the first or second time we did it. And we went 3 hours, and I totally forgot about them. And finally, at about the third hour, she peeked out, and she still remembers. She's traumatized by that. That's why she asked me that right now. No, I'm kidding. But they came out and said, "Daddy, can we come out of our room?" And I was like, "Oh man, 3 hours. All right, you can come out now."
So Sunil is asking, any advice on the mental aspects of trading? So Sunil, that's a little bit ambiguous because there's like certain things that require different stuff. But I think he's mentioning discipline, over trading. And I think the discipline part, I find it easier to be disciplined in swing trading than the day trading because of the speed.
Definitely.
But it's all the same stuff. I mean, do you have any advice on that?
A couple. One, I think you should identify. I mean, there's so many things you can be hitting. And if you try to master all of it, you're going to master none of it. So identify maybe the 2 or 3 things that you really have issues with. One of mine was I was constantly loosening my stops and didn't really realize they weren't huge losses. But when I went back and analyzed my results, over 6 months, I was seeing that by loosening them, I was losing a lot of money. It wasn't really helping me. So that was an issue I had mentally. That I wasn't able to just get out of this. This is years ago. I couldn't get out at the right spot, so I identified, okay, this is an issue I have. And I made it front and center. Every morning, I talked about it to myself before the market opened. I had a little post-it on my computer, and I would just look at that every day.
I know till this day I make posts.
Yeah, exactly. Yep, there we go, right there. And you just, it's a lot of self-analysis and just hitting those main points. You know, if you have some little things, don't worry about those, but identify what is a real problem, first of all. You know, do some analysis of it, and then just attack it. That's basically it. There's no magic formula that's going to eliminate it. The other thing is, you're always going to have these emotions. And I get asked all the time, because in the videos in the morning, the market could be down 3%, and I sound the same every single day. It's not that I don't have these emotions. It's just learning how to kind of adapt yourself to these different emotions you might be having.
Coach Shake, just to answer your question, Coach Shake's asking, like, why is JNUG and Nugget move so much? Like, some days gold moves 0.2%. Often gold might move 0.1%, and Nugget or JNUG could be up 10%. And Coach Shake, the reason is that Nugget and JNUG actually follow the gold miners, not the price of gold. So, like, the price of gold is up, whatever, 25% off the bottom. But gold miners, because they're all just so cheap, right? They're up 500% off the bottom. So if you're looking at any of these, PAS, SA, you know, any of them really, it doesn't matter. I mean, they're all up numerous hundreds of percent.
And then with the gold miners, it's actually supply and demand in stocks rather than just going after the commodity itself. So
people are looking for stocks off the bottom. That's it. You know, the bottoming patterns are bottoming patterns. You know, people got to throw their money in somewhere. And I think in this commodity chase, I mean, it was just literally, okay, let's go after these. Then this is like the next wave and the next wave, and they just started to go.
Yeah.
Brandon, can you explain the definition of loose stop versus tight stop? That's just in relation to how far you're putting your stop loss versus where you bought it. You know, sometimes people just arbitrarily use stop losses, like I'm going to just use a 1% stop loss or 2% because they want to manage their risk, versus actually using the nearest support level or the nearest pivot level and then giving a little bit of room under that for, you know, some shakeouts. It's kind of, you know, those are the two different things. Just because your stop is tight doesn't necessarily mean you're managing your risk properly. When you're looking at sector analysis, what sort of time scale are you looking at? Year to date or just 1 year chart?
You know, I guess it really depends on what that sector has done. So, you know, we're keying in on the last 30 days here with commodities. But I do want to know, going back, where it is in relation to the trend. You know, that it's been in a downtrend, it's breaking out from that. So you do want to kind of key in on that. But my weekly analysis is looking at the 30-day and then the 5-day. So the 30-day is going to give me that overall trend of what's been working. Then through the 5-day, I can identify some things kind of early on that might be ready to move. You'll get more mixed signals in the 5-day. For instance, even though commodities is the hottest sector, over the last 5 days, it's actually at the bottom of the 5-day, just because it's pulling back. So I kind of keep an eye on both there.
When do you plan having your next boot camp, Pratik? I mean, May 23rd. When you're swing trading, how do you avoid gap downs when you're long and gap ups when you're short? Part of that is actually market timing too. You know, if you're buying a bunch of swings when either the market's hitting resistance, or if you're buying swings when, for me, I just use rudimentaries. I spend much less time swing trading than day trading. For me, if the market is below the 50-day moving average, I find that there's tended to be more gap downs than not. You know, when the market is in downtrend like this, there tend to be more gap downs than not. And so during those times, I won't add longs unless I find a series of things happen that tell me that the market is so oversold that now is the time to get in.
Yeah,
But if
so
I'm just
the
talking
difference
middle of the
would be
range, no.
those, like when we saw the bottoming formations, even though they were below the 50-day, you're getting that pattern, you're getting the money flow where you don't have to worry quite as much about the gap downs. But it's going to happen. You can't predict for crazy news events. So it is something you have to learn to deal with. You can always protect yourself by taking less risk. Instead of risking 1%, you can risk 0.5%. And then if it gaps down, you're not going to get hit quite as hard.
Felix, do you guys trade UWTI and UGAS? I actually don't trade UGAS almost ever, but the UWTI I do.
Same thing for. I don't think I've ever traded UGAS, but
UWTI
all the time.
Just from looking at UGAS's chart, to me is just, first of all, it's more gappy than oil, I've noticed, and also has less intraday range. And also just, how many? I don't know. To me, there's always something a little bit weird about natural gas. It just never moved.
I don't think I've ever made a natural gas trade, and I don't know. I can't remember the last time I traded natural gas.
Steven, any reason that sometimes people use exponential for some EMAs, some MAs, and not for others? It's actually pretty easy. Just kind of try what works.
Yeah, exactly. I've always used simple moving averages, and basically, the moving averages aren't real, right? We've created them, and it's kind of what everyone's trading off of. Whereas price action is actually real. So I'm just looking at what everyone else is doing basically on these, and more people are watching the 9 EMA for some reason. I have no idea why. So that's what works here.
Dun, 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 dun. How long is boot camp? Seems I'll need to put in vacation time at work. No. All classes are at night. All classes are at night. No vacation time at work. You're going to learn all different types of trading. Guys, if you have a job, do your job right. Right? This type of stuff is always going to be around. You do it at night. I did my trading and built up my bankroll trading while I was at work. Paul did the same thing. Paul actually was a lawyer. I
was working days. Yeah, then I'd come home, spend time with the family, and I didn't start my research until everyone went to bed at about 10 at night. And I'd be done by about midnight, and then put in my trades during the day on breaks. That was it.
Travis Simpson, do you ever use buy stops? I don't. But I'm always in front of the computer.
Yeah.
Dun, 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 dun. Mr. Mercury, do you like VMI again now that the selling has subsided?
So I took a trade. I actually took this trade. So I was playing it as a kind of a high type flag. Post breakout, when it was consolidating up here, it kind of pulled back with the market. Now there's really nothing to do with it here. I just probably kind of wait and see if it can break out of the highs.
Dun, 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 dun. What if something's like 18% pullback in markets this year? Would one or more sectors emerge, or do you adopt completely different strategies? If the market pulls back 18%, I'll make more money than maybe I ever have in the history of my life. If it does it, we'll be ready. Yes, we'll do more shorts and stuff like that. And I'll still do longs. It'll just be more rubber band longs. Only if I see very, very specific conditions. I won't long just a long. But 18% pullback is not a big deal. Frankly, we haven't had a pullback in so long. That's 18-20%. The pullback you make money on.
If we pull up SPY here, what I've been watching for right now, which we got today, was the break of the 9, which was a good thing. But so now I'm thinking about getting more aggressive now that we broke the 9. But I actually would have loved if we broke down below the 200. Because at that point, we could have got a really nice flush. And while it's scary, that's when you really could have made a lot of money here, or could potentially make a lot of money there.
Yeah, you get a lot more rooms. And so the other thing, guys, in this market, historically over the last so many years, a 20% pullback will happen in a matter of maybe 2 weeks. So you get a 20% pullback in the market, tops 1 month. But if you look at the history of the big pullbacks in the market, the most of the damage is done in a handful of days. So a 20% pullback, it could happen in 2-3 weeks. And then all it's going to do is it gives you a chance to reset a lot of charts. New bottoms will form and new leaders will emerge. There's nothing wrong with it. You know, there'll always be that pullback. Just gives you an opportunity to reshake something. If you think about it, this last pullback in the market, we would have never got the big commodity run as explosive as this if we didn't get this pullback, because that's where we got the capitulation in the commodity stock.
Oh yeah, I mean, that gave us the opportunity. So, you know, we wouldn't have these nice results here without that. So you should probably, rather than fearing it, almost hoping for it to happen, because then that's where really the opportunity lies.
Hey Reggie, so Reggie's asking, you know, when the market rolls over, will you be looking for stocks off highs? Yes. So I mean, my biggest trade of last year, or this year in the beginning, was just shorting this Amazon. You know, once I saw this flag, I mean, when the market's rolling over like this type of flag almost never works. I mean, you're almost always looking at a fake out, and you'll get these stocks like Netflix and Amazon and all these things roll over big time. And it'll happen for a couple weeks, maybe a couple months, and you get your nice play, and then you go back to it. Guys, there's no fear in markets turning over. In the last 8 years since this bull market's happened, there's been 6 or 7 times we've had 10% to 20% pullbacks. It's nothing. They last a few weeks. You shake it out, and then you're off to the races. So, guys, I think that is it for now. Feel free to email me if you have any questions or we missed anything. I know sometimes it's a little bit hard with so many people in a webinar. I think we got to everybody, but if I missed something, it's not because we were intentionally trying to miss something. We had 700 people for the webinar registered. The questions come in so fast, I try to answer them as best as I can. So it's a Kunal at bullson.ws. Email me if we missed any questions, or you guys have any questions on anything. You know, you can feel free to send me a little text if you want. 517-974. I don't even know my own number. 1480. I'm so used to not doing all this type of stuff. So feel free to text me or call me. Paul, thank you. 2 hours and 20 minutes. You tell your daughter.
This is great. This is great. Hey, we didn't hit the 3 hours. She asked me. We're going to go 3 hours.
We didn't hit the 3 hours. Guys, if we missed anything, just email me. I'll be up tonight. You can email me. I'll make sure to get to you. Kunal at bullson.ws.
All right.
Don't be afraid to contact me. Guys, I have so many students, I wouldn't even know if you were a student or not. So you just, you can send me an email, and I just make sure I reply to everybody. So, folks, I will see you all later. Thank you, Paul.
All right. Take care, everyone. See you at the boot camp
Peace.
or next webinar. All right.